Hi everybody, it's Brett Mills with Academy Mortgage Corporation. I have a couple of my business partners, Brad and Jess, here with us today. Getting a lot of questions right now about what's going on in the market. Specifically, I'm going to focus today on some of the forecasts and pressure we're going to see on interest rates, at least what we're seeing. And also actually speak a little bit from an industry standpoint, kind of what we're seeing on the back end of mortgages. So go two different directions today. But first, I think it's important to note, historically speaking, over the past decade, when the stock market has actually gotten extremely volatile like it has, we've actually seen mortgage rates drop. And that's for a couple of reasons. A mortgage-backed security is a form of debt. And so I want to pick today, Jess is going to be our investor because there's two parts of a market that work together. Jess, as an investor, wants to get a return on his investment. So he's got money to spend and wants to invest, and that's going to be consumers out at large using their 401ks and different things, or buying an investment. Brad is going to be our borrower. So we've got consumers that are borrowing money trying to afford to buy a house. And so that's what funnels that money and creates the ability for Brad to buy a house, as the investors provide the money, and there's got to be a spread there to where Jess is being happy and Brad can afford it. So for a long time, we've actually seen mortgage rates really, really low, even when the market's been extremely volatile. And that's out of a fundamental principle around what we call inflation. The basic concept of inflation is that, let's say you're at a 2% inflation rate. If I have $100 today and I can spend that, well, cost of goods go up. So gas, groceries, all those types of things, it's going to take $102 next year to be able to afford that. Well, from Jess's standpoint, let's say that he has an option. He can put money in a savings account at the bank and make 0.25%. But if inflation is at 2%, for example, he's really only seen his money grow by 1.7%. He's actually losing 1.75% of his spendable money a year from now. So he's going to have less to spend, is really your difference that it's looking at. So that becomes important to Jess wanting to get a return on investment. He can't just leave his money in the savings account, or it's actually going to deplete his investment. So you go to one of the next securest investments for Jess is going to be a U.S. Treasury bond or a mortgage-backed security. So let's say that he goes and says, hey, Brad needs money to buy a house, and the market's kind of saying around 3.75. Well, what's a realistic spread? So if Jess says, 3.75% on what we call a mortgage-backed security, that is what he is buying. He's getting a difference of 1.75. His money's going to grow 1.75% more than he's going to lose in inflation year over year. And that's really critical when it comes to mortgage debt, because investors are not wanting the volatility that's going on in the stock market. And that's, like I say, typically speaking, inflation's been really low for the past decade. And so it hasn't been a big deal when the stock market's come down. People have fled and bought mortgages, which has created a huge supply of money. And so that's a change. Right now we're seeing inflation go up, and a lot of that is stemming from the tax reform. And that comes back simply that people have more spending power, cost of goods. We're actually getting more investment back in the United States. And so I anticipate inflation will actually continue to go up and continue to go up. So if that's hitting up now, for example, let's just say that it goes to 3% on inflation rate, and that's hitting like 2.7% right now, a dramatic climb and increase. And that's why we're seeing the markets go. So if inflation increases, then in order for Jess to get a return, that rate has to go up as the investor. He's got to be looking at saying, well, man, if it's 1.75, then my mortgage rate really needs to go up as well at 4.75%. The challenge being right now, maybe to speak to the industry participants, we're seeing this concept of premium or margin getting squozed. There's not as much going on. Typically speaking, we can forecast and say, hey, we can give you 200 basis points on a mortgage that helps pay Brad's closing costs. That's how that happens. You go to a little bit higher interest rate. Jess says, you know what, I'm expecting over time I'm going to make more money, and so I'm willing to give you, 2% of that loan amount right up front to pay Brad's closing costs. That's simply how it works. Well, if that 4.75% rate right now, it's extremely volatile, Jess is looking at it from an investor saying, man, I don't know what's going to happen to inflation a year from now. I don't know what's going to happen 2 months from now. We're in an unknown territory. Well, Jess is looking at saying, man, if I put it at 4.75, what if Brad does our mortgage at 4.75 and 6 months from now it says, hey, rates did drop. I'm going to refinance at 4%. Well, Jess is going to lose a lot of money because he fronted all the money to pay his closing costs. And so that's why we're seeing this margin compress, or the ability, what we call premiums, to compress to help pay closing costs because of the uncertainty in how sustainable. We don't know some of these variables because we're in uncharted territory. That was the biggest tax reform, really, largely in the history of the United States that was just passed. And so unknown variables are causing that margin compression. So that's just hopefully helpful a little bit for industry participants on at least my take on what's happening there. The other part from a consumer standpoint, because of this inflation number going up, I think this is a different game this time. Typically speaking, once again, when the stock market's crashed, mortgage rates have gone down, but because of that underlying inflation pressure and what's happening to bonds and Jess's need to get an investment over and above that, that's where I'm anticipating interest rates to continue to rise. From Brad's perspective, even though interest rates and this cost is going up, with inflation, it can actually be a good and bad thing. In theory, Brad should have more money to spend every month because now he's getting more net income out of his paycheck because of the tax reform. And so that can help offset a little bit of that. So it works a little bit in tandem, but due to some of the uncertain factors, that's why this time I actually anticipate interest rates to continue to creep up. Feel free to reach out to any member of our team with any additional questions you may have. Hope you found this video informational, and we'll talk to you later.